Alright, class, today we are going to talk about accounting for groups of companies. When we say group of companies, it involves at least two companies, which is the parent company and also the subsidiary company. But what constitutes a parent and a subsidiary? We'll look at it now. So, a group of companies include parents and subsidiary, but you can have more than one subsidiaries. So, at least two companies in a group. And who is a parent company? A parent company is who have achieved control in a subsidiary. Then, what is control? Control is when the investor is able to influence the decision making of the subsidiary, which result in the investor has power to vary the return from the subsidiary. For example, when we say power, it is the ability to direct relevant activities in the subsidiary. But how they exercise their power, it can either come from voting rights, potential voting rights, or right arising from contract. That means, for example, if you are a shareholder, and in the shareholder meeting, annual general meeting, when the company propose some proposal, and the parents company is the investor who are able to give an instruction on whether to proceed on that proposal or to discard the proposal. How the investor can exercise their control? If they hold share, they can voice out, but not necessary that they have the power to affect the decision. They must able to affect the decision if they have more than 50% of share. If you have more than 50% of share, you have the power of telling the company whether or not to proceed with that investment. Then the investor is having power, having control on the subsidiary. To summarize everything, a group consists of parents and subsidiary, and this relationship exists when the investor achieves control on the investee. The investor is then called a parent company, and the investee is called a subsidiary company. And how control is defined? Control is defined as when the investor has the rights to vary the returns from its involvement with the investee, with the subsidiary. And all the accounts must be consolidated unless control is lost. When we say having the power to vary returns, the powers can come from voting rights or arising from contract. And one example to tell how the parent can vary the returns it has from the investee is through participating in decision making. Then they can affect the dividend payment, the remuneration, and also other operating activities of the companies, and hence affecting the return generating from this subsidiary company. Now, next, consolidation overview. Let's do a practice here. P has purchased all the equity share of S and achieved control in S on 1st of January 2025. The date here is very important. So when a parent company achieve control in a subsidiary on this date, this date will then become a cut-off date. Whatever transaction happened before this date, we call it pre-acquisition. And whatever happened after the cut-off date is post-acquisition. This cut-off date is very important because we only consolidate whatever after, whatever is post-acquisition. Whatever before pre-acquisition transaction, we wouldn't consolidate them because those are the transactions that happened before the parent achieved control. Hence, it is not right to consolidate those transactions. So now let's look at an overview for consolidation. Each parent and each subsidiary, they will have their own financial statement. The financial statement here is those what we learned earlier: statement of profit or loss, statement of financial position, statement of cash flow, statement of changes in equity. They will have their own sets of financial statement. And then when the parent achieve control over the subsidiary, we will need to combine their financial statement and form a group financial statement here. And remember, acquisition date is important because it split the pre-acquisition and post-acquisition transaction, and we only consolidate the post-acquisition transaction. But we cannot take it bulat-bulat P plus S. There are some adjustments to make before we come to a group financial statement. The adjustment that you are going to learn here is goodwill or bargain purchase. This is the differences between purchase price and also fair value of net asset acquired at acquisition date. Is similar to what we have done in our partnership account earlier, the merging and taking over. Next, non-controlling interest is also one of the adjustments that we have to make. This exists when the parents do not control 100% of the subsidiary. So if the parent control 100% of the subsidiary, then you don't have any adjustment to make for non-controlling interest because there is none. You control the whole of the subsidiary company. There is no non-controlling interest, hence no adjustment needed. But control is achieved as long as you have the power to influence the decision making of the subsidiary. Then you have already needed to consolidate the account. It means that when P has 60% voting right in the subsidiary company, you already need to do a consolidation. But how about the remaining 40%? The remaining 40% belongs to non-controlling interest. Hence, we have to do some adjustment for the interest that is not controlled by the parent company. And last, elimination or cancellation of intra-group transaction. When P and S, the parent and the subsidiary, they prepare their own set of financial statement, they recorded their own transaction, including, for example, if P has sold some goods to S in P accounts, it will record as a revenue, while in S account, it will record as a purchases. But when we consolidate the account of both P and S into one set of financial statement, one group account, this kind of transaction shouldn't exist because it is like you are selling from your left hand to your right hand. And when we look at you as a whole, as a complete entity, we don't consider this intra-group sales as a transaction within the group because it is just a transfer of goods from P to S, but now they are one. So there is considered as no transaction when you look at it from the group perspective. That is why when we are preparing the group account, we need to eliminate all the intra-group transaction. Now let's look at the practice down here. So P has acquired S and achieved control on 1st of January 2025. And on that day, the fair value of S, the subsidiary sundry asset, is 150. Effect of depreciation can be ignored. Okay. The day here is 1st of January. So that means full year impact, whatever happened during the year can be consolidated because there is no pre-acquisition period in this example here. Now let's do the practice. How do we consolidate a group statement? The fair value of the subsidiary is 150 as at the day of acquisition, but actually in S book, the sundry asset is recorded as 130. So there is a revaluation gain in S book. That's why we need to make an adjustment. We need to add 20 here. But when we have add 20 in asset, remember accounting is all about double entry, where the other entry should go. The other entry should go to equity. Why? Do you still remember what is included under equity? You have share cap, you have retained earning, and you have a lot different types of reserve, where in this case, we call it a revaluation reserve in the subsidiary books. So that now you got a balance as OFP. The fair value adjustment for the sundry asset in the subsidiary company is debit sundry asset 20, and then you credit revaluation reserve 20. Now we need to do second thing. Goodwill or bargain purchase adjustment to calculate for the goodwill that happened during the acquisition. In the parent's book, it shows that it spent $160 to purchase the investment in S. That means the purchase consideration transfer is 160. And what are the things that P has purchased from S? We will take fair value of net asset at the acquisition date. Net asset, as we have talked about earlier, it is equal to all asset minus liability. Hence, you will have 150 being the revised fair value of sundry asset minus with your sundry liability, which is 40, and then you get the fair value of net asset purchase as at acquisition date of 110. But instead of using asset minus liability, remember A minus L also equal to equity. So we can actually take the equity figure directly. When parents spend this money to buy over the subsidiary company, what they are buying? They are actually buying the share capital of the subsidiary company, and they buy the retained earning from the subsidiary company as well. And because there is a fair value gain of the sundry asset on the acquisition date, the parent company is also buying the revaluation gain in the subsidiary company. So when we put in 60, 30 fair value adjustment here, the company is actually spending 160 to purchase the net asset of 110 from the subsidiary company, and hence there is a goodwill of $50 generated from the purchase. Now we got all the figure for P and S already. We need to combine them into the group account. As we said earlier, we need to eliminate all intra-group transactions when we are doing a consolidated account. So let's look at this. Investment in subsidiary, 160. This is the money that parents spend to buy over the subsidiary. So this is considered as an intra-group transaction which need to be eliminated. And bear in mind, when we want to eliminate transaction, double entry, we need to eliminate from both the asset and also the equity or liability part. So let's assume that we have a minus 160 here. Where should we minus from? At the bottom part. Parents spend 160 to buy over S. So this share capital is being purchased over. So in S book, this one need to be taken out as well. The retained earning taken out, and the revaluation reserve also need to be taken out. So we have minus 160 here, but we only minus 110 here. Then where the other 50 will go? From your calculation here, the other 50 will go to goodwill. So the whole impact in your asset is you have reduced by 110, and in your equity part, you also reduce by 110, 60, 30, and 20. And let's come back to this calculation. When we want to zeroize the 160 in P's book for investment in subsidiary, we will credit this account, right? Because currently investment asset is a debit account. So we credit from here. And in order to zeroize the equity in the subsidiary account, we will need to debit the share capital, we debit the retained earning, and we debit the fair value adjustment as well. And from the group perspective, this is the goodwill of the group. So we need to debit another $50 to our group's account. And hence, we got a balance 160 and 160, and now we can consolidate everything into our group account. 160 minus 160, 0. You no longer has the intra-group transaction here. And sundry asset, you got 200 plus 130 plus $20, 350, and you have a goodwill of 50. Share cap, no more share cap and retained earning in subsidiary books. So we have 140 here, 120 here, only from the parent company. Revaluation reserve also being zeroized. Sundry liability 100 plus 40, 140. And you got total equity and liability of 400 and also total asset of 400. That is a simple version of account consolidation. Now, let's go back to our note. We have completed practice number 1, and let's see practice number 2. So, following practice 1, it is the year end now, and then the SOFP of P and S are as follow. Remember, P and S, they still continue business as usual, so they will still have their individual set of financial statement. But now when we are consolidating their result into a group financial statement, we need to do adjustment for the goodwill, for the fair value adjustment, and also for any intra-group transaction. And also, because P has achieved control in S from January 1st of January 2025, any transaction happen after that, any profit or loss generated by S after the day of 1st January will belongs to the parent now. Last time, when we are doing this consolidation account, this is the first day when P achieved control. So whatever retained earning inside S account belongs to those profit generated by the subsidiary company before the acquisition date. So all this pre-acquisition profit is not belongs to P, the parent. That is why we don't take at all. But now, 1 year after the acquisition date, the retained earning of S has increased from 30 to 50. There is a $20 increase. And this increase happened after P has control S. So P has the right to share the retained earning here. Let's do the practice 2. Similar like the practice 1, what we have do earlier, we have the same fair value adjustment. We have same goodwill calculation. And now we put in all the adjustment here again. 160, we credited from investment in subsidiary, then we will debit to share cap, retained earning, and fair value adjustment, and also goodwill. But we only debit 30 to retained earning because this is the money that we spend to buy the subsidiary when they have $30 in their retained earning account. After that, the additional profit that is generated by the subsidiary after the date of acquisition, 50 minus 30, the $20, is part of the profit of the parent as well, because I already achieved control in you. So whatever you're earning is my earning as well. That is why when we consolidate the account, we will take the parent's earning plus the entitlement of parent's earning in the subsidiary account. Let's look at it one by one. 160, we eliminated, so it's 0. Sundry asset plus 160 from the subsidiary, but because the fair value adjustment, $20, so we included here, and hence it's showing a 430. Goodwill as per the goodwill when you acquired the subsidiary. And now share cap is still the same. This is the share capital of the parent. Retained earning. Now we will take the parent's retained earning 190 plus the subsidiary retained earning. This is accumulated retained earning. So we need to minus out the retained earning of the subsidiary before acquisition, which is 30. So we get 210. Now fair value adjustment no more from group perspective. And sundry liability, we add on them together, 130. And this is the consolidated account for the group.